Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, full coverage from the Federal Reserve's annual Symposium in Jackson Hole, Wyoming. This hour, we'll hear from Kansas City Fed President Jeffrey Schmid. Plus, Walmart missing profit estimates for the first time in years. We're going to break down why. And ESPN launching its standalone streaming service today. We'll break down the latest in the streaming wars and more on Market Catalysts. First up, let's get a check on what's going on in markets at this hour. We are seeing the major averages under pressure at the moment. The Dow trading lower by about 230 points. That's about 0.5%. The S&P 500 down also about 0.4%, and the Nasdaq down 0.5%. So unlike in recent days where we see the Dow outperforming and the Nasdaq underperforming, all three major averages are under pressure. A couple of things going on here. You did have jobless claims this morning coming in a little bit higher than estimated. And then we just in the past 15 minutes or so got some data from S&P Global on manufacturing factory orders, and those came in at their best reading in a couple of years. So what does that mean for the Fed? What does it mean for Jay Powell and what he's going to say tomorrow? The market is definitely paying a lot of attention and is concerned about what we're going to hear from the Fed chair. If you take a look at bonds here, we are seeing a little bit of an uptick here in the 10-year yield. But, you know, as we've seen stocks selling off over the past few days, there hasn't necessarily been a clear trend in the bond market. Right now, that 10-year yield at 4.32%. And then digging into what we're seeing within the Dow Jones Industrial Average here, you see big cap tech continue to feel some pressure here. NVIDIA just down 0.25% today. Amazon, though, down 1.2%. And then we've got Walmart somewhere on this screen. There it is in dark red, down 4.6%. So definitely that is the weight on the Dow today. But to the point about these large cap tech stocks, let's look at the NASDAQ 100. The sell-off that we've been seeing over the past few days for the most part is continuing, if moderating, right? So Alphabet shares are turning higher today. Apple is only very slightly lower. If we look at the 5-day chart, we though see that more stress that a lot of that large cap tech has been under, especially in focus as we go to NVIDIA earnings next week. So going to continue to watch the tech trade very closely. But let's talk about the retail trade as well. And Walmart shares they're sinking after the company missed earnings estimates for the first time since 2022. Still, the company did raise its full year guidance, in particular for sales, as the CEO says they are not seeing dramatic shifts in consumer behavior due to tariff-related cost pressures. Joining me now is Oliver Chen, TD Cowen senior research analyst, and our Yahoo Finance senior reporter, Brooke DePalma, who covers retail for us. Good to see you both. Brooke, let's start with you on sort of some of the takeaways from the earnings and what investors should be watching.
Yeah, right now investors largely focusing in on that earnings miss, and that's because this was the first time that this happened since 2022. For the quarter, adjusted earnings came in at 68 cents. That was just short of the street's expectations of 74 cents, and they largely said that was because of one-time expenses like insurance claims, litigation, and restructuring costs. But on the flip side, the company did raise its outlook and now expects adjusted earnings to come in the range of $2.52 to $2.62 for the full fiscal year. But another thing sort of weighing over the head of Walmart this morning is potential tariff impact in the latter part of the year. They said that total like-for-like inflation is about 1.1% for the quarter. And on the call, we also heard from executives say that as they replenish their inventory with post-tariff levels, they're going to have to raise prices in the third and fourth quarter. And this is largely a company that's been able to win over customers in the past few years because of lower prices.
So, Oliver, I was just looking through your note reacting to the Walmart numbers, and you don't seem that concerned about the sort of margin puts and takes here from tariffs. So talk to me about that.
Yeah, Julie, what we're excited about is the comp store sales. So they were at plus 4.6. Street was looking for plus 4. So on the revenue side, quite strong here. Also, as we think about technology and the retail nexus, they're hitting on many cylinders, including e-commerce growth that's 25%. Keep in mind, Target grew at plus 4%. and also Walmart Connect digital advertising. So you have a retailer that offers exceptional value in grocery, and that momentum is continuing. At the same time, there's an AI story here, there's a digital advertising story. Those are things to watch. But as Brooke mentioned, gross margins and SG&A were softer than we expected this quarter. At the same time, they raised guidance. So there's puts and takes. And what's on everybody's mind for the consumer is definitely inflation, buying goods closer to need as well in advance. That's something management is watching. What they're seeing is when they do raise prices, the unit count goes down. So customers are quite sensitive to these prices, and the magnitudes been about 1% overall. So there are some puts and takes. We like Walmart for the long term. We are not surprised that the stock is weaker because expectations were fairly high. Keep in mind the price to earnings ratio was 37 times. So there's a lot to love here, but it's a mixed print in terms of thinking about those margins.
Well, and Oliver, it seems like, I mean, if you boil it down, basically they're willing to sacrifice margins for volume, it seems like, at the moment. But it's also a real reminder, I think, of that tariffs are real, that they do have an effect, and that this is a potential example of that.
Yeah, for sure. And Walmart has a history of everyday low prices in the community. I grew up in Louisiana, going to Walmart every day. And thinking about Walmart and value, they go hand in hand. So this company will manage expenses very tightly. What's really fluid is managing this gross margin in light of these cost increases. However, bigger is better right now in retail. And as we think about more broadly, you need to offer customers value plus exceptional convenience. So part of the story here is digital meets physical as well. As you think about curbside pickup, as you think about marketplace models, and all the digital convenience that customers want. Customers want value in the form of delivery as well. Keep that in mind. Walmart's very well positioned to manage prices better than anybody else. The other stock we like, Costco and BJ's, again, that's a value concept too.
Oliver, as we try to sort of see these tale of two tales of retailers, I guess, Target and Walmart, it was interesting to hear that both of them had said that their inventory was up about 2% over the quarter. As we make way to the holidays, how concerned are you that these retailers will be able to sort of understand their inventory levels as the consumer pulls back and as these tariffs take effect?
Yeah, there's a lot to be concerned about as well with an anxious consumer that's expecting higher prices. And there's a tale of different cities happening here. Home category, big ticket items, those have been under more pressure. Apparel, it's been mixed. Today from Walmart, they've done a great job with style and also adding items to their online marketplace. That's been helping a lot. At the same time, Target's apparel numbers were negative. So I think it's going to be a mixed bag. Overall, as we think about back to school, we're very bullish on denim. So we like players like Levi's, and my colleagues like players like the Gap as well. And the consumer is actually in a pretty good place with spending power. So the consumers do have spending power. That's something we like. And that's on the basis of low unemployment, as well as $1 trillion on the sidelines. That being said, the big issue here is volatile consumer confidence. So we continue to see that fluctuate, and geopolitical events as well. And this tariff situation, which changes every hour, definitely doesn't help with anxiety.
Definitely does not, either among the people buying the goods or the people ordering and selling the goods, I'm sure, Oliver. Let's look beyond back to school to holiday, because that's really, it feels like when the chickens are going to come home to roost in terms of this tariff situation, the consumer confidence, all of those elements you were just talking about. How should we be thinking about the holiday season for these retailers?
Yeah, I would say thematically, the consumer is struggling between needs and wants. And as we think about interest rates, that will be a big factor. If interest rates go down, it will help free up some dollars. But as we think about holiday, this big fixation on needs, meaning owning those retailers such as Costco, such as Walmart, that have a major food and grocery and need component, as well as bolting on wants. So there's a bit of a struggle between needs and wants. Oftentimes, back to school correlates with holiday. We're optimistic. Our own back to school forecast is at the higher end relative to street estimates at around +3. And we think the consumer will come out, but somewhat selectively. There's a bifurcation happening. And what's happening is a lot more pressure at the middle and lower income customer and consumers gravitating towards value. So our top ideas include BJ's Wholesale, include Costco, as well as Walmart. And value plays in that equation a lot. At the same time, there's some pockets of fashion trends. We're excited about jeans and denim. But again, when you think about jeans and denim, it's classic. It's classic with a twist. It's quiet luxury. It's a customer looking for value and versatility in the way they dress too.
Oliver, if I can dive into that tale of two different retailers here a bit more. We have Target. They're leaning into Target Roundel, their advertising business, as well as their Target 360 Plus membership model. But Walmart also has Walmart Connect. They have Walmart Plus. They're both using these other profit streams to offset the impact on margins. Why is Walmart doing it better?
Yeah, Julie, we've been really fixated on this at TD Cowen. It's called the new retail nexus. And the three things that are important for all of retail include a marketplace model, digital advertising, as well as artificial intelligence. Walmart's been very early. They've used blockchain, they've used AI, especially for training and development of their employees, for inventory management. They're using computer vision in terms of checkouts at Sam's Club. And they have this new AI assistant called Sparky. So we're watching this. But the name of the game in AI and what's happening here is speed. And Walmart's had a running start and really claiming this kind of win. Target has been a work in progress. Their loyalty program has been revamped. Loyalty programs are the key to data and engagement. And they're tough in terms of engaging customers. Walmart Plus has had a nice head start. So we're looking forward to that. Today, they also announced a credit card, which is quite exciting in terms of cash back to Walmart customers, as well as more cash back when you're Walmart Plus. So as we think about retail, it's this big ecosystem connecting all these. And then increasingly, it's physical meets digital, just given the convenience of 4,000 stores and 90% of America being within 10 miles of Walmart. That's a key premise too for the long term. So Walmart's holding its own, and it's very difficult to connect all these attributes. What's really happening in the story between Target and Walmart, Target is much more discretionary. It's about 20% food versus Walmart being 60%. That's been a struggle in terms of all the discretionary categories at Target being under pressure, as well as negative comps at Target. So we're watching that. We're also watching the strides that Walmart really is making in technology relative to Target right now, too. As we spoke with Target yesterday, it's going to be about technology, as well as Target trying to lean into style and design, what it's famous for. At the same time, Walmart's done a really nice job with style, apparel, and other ingredients, as well as getting the higher income customer in that store. I'm a luxury analyst as well, and we like what we're seeing with their marketplace and adding new brands there. That's going to be really exciting to watch.
And Oliver, today I learned that Walmart's AI assistant, I just learned from you, has the same name as my dog, Sparky. So there you go. They must have drawn inspiration.
Yeah, great being here with you.
Thanks so much, Oliver, and thanks, Brooke. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ, and let's get a quick check on stocks. About a half hour after the opening bell here, we're seeing still broad-based selling, but not as bad as we were early this morning. We're seeing the Dow off around 80 points. The NASDAQ and the S&P are roughly off around 0.1%. And in terms of individual movers, it's no surprise to see that Walmart is the top trending stock on Yahoo Finance. Shares are currently down around 4.5%. And this comes after the company did beat revenue expectations. They beat same-store sales expectations, but earnings came in short of estimates. And it was the first quarterly earnings miss since May of 2022. And that's spooking some shareholders today. Walmart, obviously a big component of the Dow, part of the reason why we're seeing some of this escalating selling pressure. Now, Walmart, compared to some of its competitors like Target, for example, has been able to manage a lot of these tariff uncertainties. Although on the earnings calls, executives did say say that consumers should continue to see incrementally higher prices as we make our way through the end of the year and as tariffs start to filter through the economy and through U.S. businesses. Now, I also want to take a look at the rotation story that we've been seeing play out in markets. And if you take a look on a sector basis today, you'll see that alive and well. Again, some of these more defensive plays like utilities, healthcare, materials, they're trading in the green, whereas you'll see tech in the red, but although just slightly here, along with financials, consumer discretionary. So something to keep an eye on as we see traders really go from those momentum names to some of these more underappreciated areas of the market. Now, analyzing a lot of this Wall Street commentary, strategists have been saying that this is an opportunity to keep buying the dips. So we'll see if retail traders continue to pile in and extend a lot of this broadening trade that we've been seeing. But for now, keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Coty, Gilead, and Rent the Runway. First up, Coty seeing its biggest drop since 2020 after forecasting a steep sales decline. The fragrance and beauty company citing tepid consumer demand and retailers clearing out existing inventory for the sales drop. The struggles come at the end of a 5-year turnaround initiative aimed at reinvigorating growth. It also comes amid reports the company is contemplating selling off its high-end brands. And remember, we also got disappointing news on this front from Estee Lauder yesterday. Next up is Gilead. The healthcare company seeing shares fall on a new report from Reuters that its HIV prevention drug will not be added to its commercial plans. Reuters citing a CVS spokesperson who said the medication will not be covered because it follows the HHS's recommendations and mandates. And finally, Rent the Runway. The company will hand over a controlling stake in the business as part of a plan to cut debt and grow. The deal with lender Aranda Principal Strategies and other partners will wipe more than $240 million of debt from Rent the Runway's balance sheet. It comes after residual effects of the COVID-19 pandemic pushed the firm to the brink of bankruptcy. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Meta has reportedly frozen hiring in its AI division after bringing more than 50 researchers and engineers on board. That's according to the Wall Street Journal. The move coincides with a broader restructuring of the division. I'm joined now by tech editor Dan Halley. Dan, this is just the latest report. There has been a lot of reporting from various sources lately that there's trouble in paradise, so to speak, in AI.
Yeah, I mean, look, there's this whole kind of reorganization that Meta's doing as far as their AI kind of setup. They're breaking it down into 4 different divisions now. They went on this huge hiring spree where there was talk of, $100 million pay packages, $1 million pay packages, scooping up people from different companies. And now it appears as though that's kind of on a hold with this freeze. But I think it also talks to, okay, now that we've spent all this money, where do we go, right? And that seems to be something that's going on throughout the industry where, you have companies now, we were just talking about off air, Eric Schmid putting out an op-ed in the New York Times talking about the idea of AGI and how Silicon Valley's too focused on that and not as focused on maybe making practical use of AI like China might be doing. There was Mustafa Suleyman at Microsoft. He had a blog post basically talking about getting away from this idea of conscious AI and being aware that it's not actually conscious, that this isn't, some kind of super smart system. It's just all an illusion.
It's synthesis, not creation.
Exactly. Yes. And I do think that there's this current going on in the industry about, we have these huge pie in the sky ideas. Now let's reel it on in. Let's take a breather and start to get serious about how these actually become products at some point. So, and I think a lot of this stuff right now, there was an MIT research paper that went out that kind of spooked everyone about how AI agents aren't all they're cracked up to be for some companies. And I think now it comes down to where does the I guess the rubber hit the road almost? Where do you get to the point where you have these products that make sense, that do benefit either workers or consumers, and we're away from the idea of this thing's going to go into a body and become the Terminator and take over and stuff like that. So I think that's kind of where the industry is at this moment. That doesn't necessarily, though, mean all the hype and euphoria around it is going to go away, although we've seen, obviously, a retreat this week as far as stock prices go. But I think that's generally where we're sitting at this point.
And it's also interesting timing-wise that we're ahead of NVIDIA earnings next week. You and I are going to be covering that, and that that the build continues, even as we are still trying to figure out how it's going to be used, what it means, what the scope of it will be, et cetera. Companies don't seem to be slowing down in the infrastructure build, in the data center build, right?
Yeah, and I mean, that's part of the reason for that is they still say that they are resource constrained. Right, so Microsoft, Google, I can't recall if Amazon said it, but Microsoft and Google for sure during their reports said that they were still resource constrained when it comes to AI. So they still don't have enough data centers built up to offer their customers access to the AI that their customers want to use. So they're not able to bring in as much revenue as a result, right? Because you're basically sitting online to get access. So I mean, they're going to continue to build it out. There are obviously benefits to AI, whether that's using ChatGPT on the regular, Perplexity, I'm a fan of. It uses everything. I think that though there's the pullback on the huge splashy spending that Meta did. That was basically them catching up and ensuring that their metaverse is kind of in the rear view. This is in the front view. But it is interesting, as you say, that they continue to build out, just as this kind of talk is starting now of, super intelligence, which is beyond human intelligence. Then there's AGI, which is supposed to be human intelligence. A lot of people say that we're not going to get there with generative AI. Generative AI it's much more than this, but if you think about it, it's kind of like the autocomplete on your iPhone keyboard.
I like that.
It's predicting what comes next in the word. So, I mean, there's a whole bunch of people that are mad at me right now for saying that, but whatever.
We'll keep talking about all this, Dan. Don't worry. And you can respond to the haters. All right. Coming up, we got more coverage live from the Fed's Jackson Hole Symposium.
It's late August in Jackson Hole, Wyoming, where a media frenzy converges around top finance and economic officials. A fly fishing invitation in the early 1980s turned into the world's most watched macro meetup. What Fed Chair Jay Powell says here can set the tone for U.S. economic policy into year end. That's right, we're talking about the Fed's Jackson Hole Symposium on today's Stocks in Translation. First, what is it? It's the Kansas City Fed's invitation-only economic policy get-together. Each August, central bankers, academics, financial ministers, and select investors gather to debate economic policy. There's no formal vote, just signals. The symposium got its start in 1978 as a regional Fed gathering. By 1982, the Kansas City Fed, they moved it to Wyoming in Jackson Hole to lure the chair of the Fed, Paul Volcker, an avid fly fisherman, and he showed up. The rest is market folklore. And after the global financial crisis, these August remarks became a thing that investors watch and sometimes trade. So let's highlight now what Jackson Hole is and what it is not. It's a policy symposium, a gathering to discuss big economic trends and ideas. It's speeches, papers, and debates. But don't call it a Fed meeting. There are only 8 official FOMC meetings each year, and Jackson Hole is not one of them. There's no formal action, no vote, no interest rate decision, and no economic projections. But the Jackson Hole Symposium isn't just Fed officials, central bankers, finance ministers, and top economists. They're comparing notes, stress testing ideas, and sometimes they tip the next chapter of policy. The guest list is very small, but the echo is global. The conversation here sets the tone for the months ahead, and after the summer ends and everyone gets back to business, well, that's when the policy making starts. Taking stock of some of the more notable years, we had to begin with that 1982 meeting that snagged the interest of Fed Chair Paul Volcker. That set an important precedent, but the meeting would not be closely watched by investors for decades. You're going to notice the next year on the list is 2010. With the global financial crisis still fresh in everyone's minds, Chair Ben Bernanke teased options for so-called QE2, lighting up the possibilities for a huge new round of monetary stimulus. Stocks rallied and investors paid attention. And just a few years later, Mario Draghi, head of the European Central Bank in 2014, flagged weak inflation expectations. This set up a big central bank pivot in Europe, once again providing important market signals. Fast forward again to the pandemic year of 2020, and Chair Powell outlined a brand new policy, target inflation. It had been in the works for years, and it was an important shift in Fed policy. Now, here's what investors are going to be listening for this year. The Fed has two mandates from Congress to consider: maximum employment, meaning a solid job market, and stable prices, which means the Fed needs to pay close attention to inflation. So, if Powell sounds optimistic about employment, that it's tight, or that wages are still growing at a firm pace, well, then that signals he's less inclined to cut rates to stimulate. That's what's called hawkish. And on the other hand, if Paul talks about the job market cooling or that wage growth is losing a bit of steam, that suggests that more rate cuts are on the horizon, which is called dovish. And when it comes to inflation, any words like sticky or stalled progress signal hawkishness, and talk of a broader cooling of prices or any disinflation, that's dovish. This might be an oversimplification, but you get the picture. Bottom line, it's a small room that can provide big signals, and what officials say there can set and reset fall policy expectations across rates, stocks, and the dollar. Not every year is seismic, but the chance of a giant reveal keeps investors tuned in, and the media coverage adds to the frenzy. Tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
The Federal Reserve's annual conference in Jackson Hole is underway. And joining us live from Wyoming, Yahoo Finance Fed correspondent Jennifer Schonberger with Federal Reserve Bank President Jeffrey Schmid. Jen, take it away.
Thank you, Julie. President Schmid, thank you so much for joining me here in Jackson Hole. It's great to have you on Yahoo Finance.
Yeah, welcome. 48th year of this conference. It's pretty amazing.
Yeah, you are set to kick off your annual economic symposium this evening. This is your second year at the helm.
Yes.
And the theme of this year is labor markets in transition, demographics, productivity, and macroeconomic policy. We know that there are changes in immigration and immigration policy, I should say, that are impacting the labor market and the supply of labor. At the same time, AI is here. Mm-hmm. How are you thinking about the theme this year and the longer-term trajectory of the job market, given policy changes and longer-term dynamics at play?
Yeah, I tell you what, we design these things 8 or 9 months ahead of time, and you hope that the subject matter, because it's very researched, there'll be 4 major papers launched at this symposium. It's a subject, frankly, that I've been really interested in for a long time, and it's not just national labor force dynamics, but it's global. And so I think you're going to see emerging from this conference really a better understanding of how the labor force is growing, shrinking. You'll see subject matter like fertility rates, migration patterns inside the U.S. Certainly things like immigration policy affect labor force. And then, as you brought up, AI. I mean, I think there's a natural thing going on with, I'm a baby boomer. As baby boomers retire out, how are we going to kind of fill back? Because we're not having children at the rate we used to have, 50 years ago. So I think the timing and the convergence of all of these things are going to be, I think, quite important, not just for the American economy, but for international economies.
Turning to the more near-term outlook for the job market, the government jobs report for the month of July showed a weaker payroll number. You said in a speech on August 12th, you think that the labor market is still healthy, it's still balanced. If we were to get another weaker reading on payrolls for the month of August and or downward revisions to July, June, sort of forcing down the 3-month average into negative territory, would that concern you? How would you look at that?
So we have a very important dual mandate, as you know. We've got the stable prices and full employment. By most measures, we're in a really good range on full employment at about 4.2% unemployment rate. What we found is because a lot of, you've got data that come from two large sources. One is just the natural data that you're going to get from lots of independent and government agencies. The other data is maybe as important to me is getting around the district to the 7 states we cover in the 10th district and just sitting down around tables with leaders, business people, communities, and finding out what is the inside baseball to what's happening in both the labor force and your businesses. What I believe happened in the first couple quarters was because of all the change, there was large legislation happening, there was new immigration policy, that there was definitely probably a cooling to the hiring rate. But I think as we hear from businesses, that uncertainty maybe gave them a pause. But what is interesting in just the last couple of weeks on a real-time basis, we're seeing a different type of mentality. There's an optimism about the last couple quarters of the year. People seem to be stocked with inventory, and I think the data coming between now and the September meeting is going to be very consequential. So if we do see patterns and risk to the labor market itself, I think we'll start to consider and weigh the inflation data to the labor data, and we tend to kind of go back and forth relative to that. There's very healthy friction between those two mandates, and so we'll figure it out, I think, and I think September will be important.
If we did see negative job growth, how would you react to that?
So I think it'll be in the context of what else are we seeing. So I have a belief that we still have a long mile yet to get inflation toward the 2%. I think there's a lot of data for me that would say that we're leaning more toward a 3% inflation rate versus 2%. And I think the cost to the American people is pretty consequential, that last percent, that last mile, so to speak. So it will depend on where we see the balancing of that inflation data to the labor data.
To your point, you said in a speech on August 12th, quote, while increased tariffs seem to be having a limited effect on inflation, I view this as a rationale for keeping policy on hold rather than an opportunity to ease the stance of policy. And you warned in that speech that cutting rates could reignite demand in the economy and incentivize firms for greater pricing power. So are you less concerned about the impact of tariffs on inflation and more concerned about underlying demand? And how are you looking at the fact that services inflation popped up in July? How is that all tying together for you on the inflation front?
Yeah, I think that's exactly right. I think watching that demand data is really going to be important as we go into the third, fourth quarter. I think the nature of that demand feature and what it is doing to the price levels of goods and services, I think there is some interesting service data. The PPI was a little bit eye-opening, but the nature of that's going to resolve itself in some of the prints that come out here in the next few weeks.
To your point then, in terms of wholesale prices, we saw that really pop up for July, and that was driven by the services side. Does it concern you that perhaps businesses may pass that on to consumers in the coming months? Could consumers see higher prices in the coming months?
I think there's a risk of that. I really do. The nature of where that's coming from will be interesting to look at relative to the labor force movement. But I think there's a chance relative to some of the more recent prints, even some of the discussions we're having with businesses in the 10th district, that there is maybe a little bit of a lean toward that they have some agility to raise prices in the third and fourth quarter. So we'll see how that comes out.
So taking together your outlook for the labor market and your outlook for inflation, do you think that the case has been made, given the data we've gotten since July, for a rate cut in September?
So I think we'll see. I think our policy stance right now is, I would call it modestly restrictive. I'm still trying to figure out where some of the restriction is manifesting itself. It seems to me like we made a really good effort to get the highest inflation numbers down into the middle high twos, and trying to get that number closer to 2, I think, is important. I think it's important. It's our job to do it. Now here again, if we see friction of inflation that is creating fewer jobs in the market, then you've got another interesting conversation that, you start to talk about the stagflation
And what
elements.
would you do in that scenario?
Yeah, I think we're going to have to take a real hard look about where our lean is relative to what we need to fight first.
Sounds like right now, though, you're leaning more towards the inflation side of your mandate.
I think we're seeing and hearing, more importantly in the 10th district, that there is the risk of that is higher than maybe seeing some of the labor numbers come back into line.
So it sounds like you're looking at holding rates steady at the moment as you wait and see. Do you see any room for a rate cut at all, perhaps later this year?
Oh, I think there could be. The data will speak for that environment and that willingness to cut rates. But we have a lot of things in balance right now in the economy, in my opinion. And I'm just trying to be very careful to try to do too much that will create an imbalance.
And where do you see neutral right now?
It's interesting. So I'm a bit of a hybrid Fed president. I'm not an academic relative to the idea of neutral rate. I think it's important to kind of have that discussion about what neutral is. I think it's more of a dynamic. You've got a $30 trillion economy, the 30% of the global economy, and it's a huge, huge stew. And so what you're trying to do is you're trying to make policy decisions that are really keeping things in balance, keeping that very large train on a level track. And so that's the beauty, and I think the healthy friction between some of the labor, full employment and the inflation mandate, and I think that's a healthy thing.
Well, President Schmid, thank you so much for joining me today. So appreciate it. We're really looking forward to the conference.
Thanks for being here. Thank you.
Julie, I'll send it back to you in New York.
Thanks so much, Jen, for that interview. Appreciate it. Looking forward to more Jackson Hole coverage from you. Well, Federal Reserve Chair Jerome Powell will make his final Jackson Hole speech on Friday. President Trump hasn't let up on his criticism of Powell, calling him too late, pushing for rate cuts by year end. But with employment slowing and inflation still stubbornly above the Fed's 2% target, will the Fed chair suggest rate cuts to come in September or remain cautious with the full effect of steep tariffs still unclear? I want to bring in John Hilsenrath, StoneX senior advisor as well and Yahoo Finance contributor, as well as our senior reporter, Josh Schaefer. John, I want to start with you there. We just heard Jeffrey Schmid talking about his view. He really seemed to tread carefully around committing to September. Do you think that's what we're going to get from Powell as well?
I think tread carefully is exactly the right description of that interview he just had. And I think that's probably what we'll get from Chair Powell. What we saw from Powell last year is that he's responsive when the labor market looks like it's weakening. We saw weak job markets in the summer of 2024, and Powell proceeded with interest rate cuts. I think he could open the door to rate cuts in his talk on Friday by acknowledging the weakness in the labor market that we've seen. But I don't think he's going to open the door wide open. I don't think he's going to encourage market speculation that we're going to get a succession of rate cuts or that we're going to get a half-point rate cut. I think we'll hear words like calibrate. And I think he's going to talk a lot about the two sides of the Fed's mandate. Inflation is above the Fed's 2% goal, even as the job market weakens. So the Fed is somewhat constrained in how much it can respond to slowing job growth.
And Josh, John just talking there about the jobs picture in particular. We did get jobless claims today. What does that tell us about the bigger jobs picture and maybe presage what we might hear in the next jobs report?
Yeah, so you saw a little increase in the weekly jobless claims to a mid 230,000 level. That is not a level that economists would normally flag as overly concerning. And that number really hasn't been creeping higher in the past couple of weeks as it had been earlier this year. But the key takeaway from that actually for me was the continuing claims number, right? So the amount of Americans that continue to file for unemployment benefits every single week, that hit another cycle high, its highest level since November of 2021. That is sort of one of those data points that is in the Fed should be cutting camp. You have a lot of economists flagging that, but essentially what it's telling you is it's taking Americans longer and longer to come back into the labor market to be able to find a new job. So it's one of those small signs of weakness, and perhaps some economists coming out this morning that we were tracking some predictions that might indicate you get a 4.3% unemployment rate in that August non-farm payrolls report that's going to come out at the end of next week, or maybe the week after. I might have my dates wrong there. The week after, but it will be coming out soon, right? And sort of the key to that report, obviously, is if you get the weak August non-farm payrolls report, probably supports a cut in September. Some economists would argue that if it's particularly weak, it might support a 50 basis point cut. That's not really where the market's at right now, but that is one of the risks that's out there.
Well, but then there's the rock and the hard place situation, right, John? Because, we got the jobless claims data today, but we also got a manufacturing purchasing managers index from S&P Global that was the highest in several years. So, which would indicate maybe some upward pricing pressure. We heard from Walmart today, which indicated that its margins are getting squeezed a little bit because it's having to offer bargains to get people through the door. But that means it's swallowing some of the cost of tariffs. So the Fed, is stuck between those dual mandates, perhaps.
It's a tough spot. That S&P Global report you mentioned did actually show that prices paid in manufacturing are rising. You're seeing an upward trend there. I think what Josh described very accurately is a labor market where I would say we have labor hoarding. Companies aren't very aggressively firing workers because things could turn up, but they're also not aggressively hiring workers. So you have this stasis in the job market. And I think for me the description of where the economy is as a mild stagflation. So there's just been a lot of uncertainty about how tariff policy plays out, how immigration policy plays out, on fiscal policy. And so we're seeing some rebuilding of price pressures on the inflation side, and the labor market isn't going very far. So the Fed is not really in a position to move very aggressively. My analogy for how Jay Powell is going to manage his last walk through Jackson Hole is small steps. When you're going up or down in treacherous terrain, you take small steps to make sure you don't fall over. So he'll acknowledge this shifting environment. He'll keep the door open to rate cuts as long as there's no big surprise in the next round of data. But he's not going to encourage people to think that the Fed is going into a much easier mode.
John, I want to ask you about Lisa Cook and that whole situation where a member of the administration has accused her of some sort of fudging of where her residence is in getting a couple of mortgages. She's pushed back against that. But, obviously this adds to the pressure from the administration on the FOMC. So, given Powell's stance on this, which has been very clear, does it even make him less likely to cut because of that pressure?
There is so much to unpack with this Lisa Cook situation. Yeah. I don't even know where to start. So I'll start with your question, which is, does this make Powell less likely to cut? I don't think so. I think there's just a lot of melodrama, political melodrama playing in the background. And Powell has to make his next couple of decisions on interest rates based on the economy. That's what he keeps saying he's going to do. And that's what I think he has to do. In terms of the Lisa Cook situation, as I said, there's a lot to unpack here. But first of all, what the Trump administration wants is a majority on the Fed board. There are 7 governors. If it gets 4 of those 7 governors, it has a majority. It could vote the way it pleases, no matter who the Fed chair is. And it also has the power to decide who goes and who stays at the regional Fed banks. So going after Lisa Cook is a way to potentially clear out one of these governor seats. But I would say what the Trump administration is doing with going after Lisa Cook, how should I say this? It's very aggressive. So they're accusing her of mortgage fraud, which is a very serious allegation. If it's true, she should step down because that's against the law. But if it's not true, how do you make a referral to the Justice Department of fraud and make it so publicly if you don't have all your facts straight? It's not clear to me that all the facts have been lined up. She says she's gathering her information to make public her side of the case. But it might be that they've made a false accusation, which is a very aggressive thing to do to any person.
Well, and
whether
also,
public or private realm.
John, let's acknowledge it's also not unusual for this administration. But we'll leave that aside for a minute. Josh, I want to end with you.
Well, but wait, can I just say one thing about that?
Sure.
Like, if you're accusing someone of breaking the law of fraud, then I can't shrug my shoulders at that. Yeah, they've done that before, but this is a person from her private life who they said broke the law over mortgages. In my mind, over mortgage fraud, like that better be true, or else they're defaming this person.
Right. Yeah. Fair enough. Josh, finally, just want to end with kind of the market position on rates here, because, as we've talked about before, stocks rose even when the rate cut was not in sight. Stocks kept rising even when people were betting on a rate cut. So now that we're going into the fall, maybe there are rate cuts coming, maybe there are not. What does all that mean for stocks?
Yeah, I think so. If Powell sort of sticks to the playbook as John laid out there, the strategist take has been that might not be great for instant market reaction come Friday. So essentially you're looking at a market that is pricing a 75% chance that the Fed cuts in September. The odds are favored that they're going to cut at least twice, 2 25 basis point cuts, if not 3 times. So if Powell were to come out and sound very similar to he sounded at the July meeting, there was a note that I was just looking at from the team at BNP Paribas. They're saying that might be a little too hawkish for this market and the expectations. And I think, Julie, when we talk about market reactions too, it's always about, well, what's been being priced into the market over the last 3 weeks as we've gotten excited about these rate cuts? Is it going to shake the index? Maybe, but are small caps going to be the thing to watch on Friday? Definitely, right? Is home builders, that run that we've seen in home builders, can that continue on Friday? That will be some of the areas to watch if Powell comes out a little bit hawkish.
Right, most definitely. Josh, thank you. John, thank you. Good to see you guys. And we should mention the 11 a.m. hour of Market Catalyst. We'll speak with Beth Hammack, Federal Reserve Bank of Cleveland president. Jen will be bringing us that interview from Jackson Hole. We'll be right back. Disney unveiled its new ESPN streaming service, allowing viewers to access programming outside a cable bundle. The shift underscores just how much the sports media landscape has changed. Here with the details, senior markets reporter Allie Canal. Hi, Allie.
Hi, Julie. That's right. And for decades, sports were the glue that held cable together. But now, for the first time, fans can get ESPN without that pay TV subscription. So the new standalone app, priced at $29.99 a month, that will stream more than 47,000 live events a year. That includes NFL, the NBA, college football, as well as tennis. Now, analysts don't expect this move to wipe out cable overnight, but they do say that the symbolism is clear here, that the last great reason to stay tethered to cable is essentially gone at this point. So if we look at the timing too, live sports remains the most valuable property in media. NFL games, for example, accounted for 72 of the 100 highest rated broadcasts in 2024. And that was a year with a presidential election and the Summer Olympics. So that just goes to show how intense NFL games are when it comes to viewing habits, and why tech giants and legacy broadcasters alike are pouring billions into sports rights. Amazon has Thursday Night Football. YouTube TV took over Sunday Ticket. Apple streams Major League Soccer and MLB games. And just after its merger, Paramount Skydance locked up UFC rights with a $7.7 billion deal. And even Netflix has jumped into the game, paying a reported $75 million per game for exclusive NFL Christmas Day matchups. And that's a 3-year deal that Netflix signed last year. And as Disney CEO Bob Iger reminded investors earlier this month, the company views streaming and cable as essentially one in the same. He said, quote, "We don't really look at being in the linear business and the streaming business. We're in the television business." So the bottom line here is that ESPN's streaming debut, it doesn't just cement Disney's pivot to digital, but it also marks a fundamental shift in how fans watch sports and what's ultimately left of that traditional cable bundle, Julie.
Allie, thanks so much. Interesting stuff. Stay tuned for the next hour of Market Catalyst. We'll be right back. Coming up this hour on Market Catalyst, first up, full coverage from the Federal Reserve's annual symposium in Jackson Hole, Wyoming. This hour, we'll hear from Cleveland Fed President Beth Hammack. Plus, as President Trump's trade war filters through the economy, one company may have to raise its prices for the first time. And we'll talk the state of Gen Z investing and clear up some common misconceptions about the new batch of investors. All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. And what we're seeing across the board is continued selling, but we're up off the lows here. The NASDAQ in particular going back to little changed. The S&P 500 down about 0.4%. The Dow off by about 1/5%. Our Fed correspondent Jennifer Schonberger is in Jackson Hole for the Fed's annual symposium. She's speaking to Federal Reserve Bank of Cleveland President Beth Hammack right now. Jen?
Sorry. Julie, thanks so much. I'm joined now by the president of the Cleveland Federal Reserve, Beth Hammack. Beth, thank you so much for joining me. It's great to see you.
Thanks for having me here. It's great to be here.
It has been exactly 1 year to the day since you took the helm as the president of the Cleveland Federal Reserve. From where we sit, we had a weaker reading on the jobs market. We're not going to get another reading until September 5th. At the same time, we saw inflation bubble up a bit in the month of July. So when you look at both sides of the dual mandate, which side are you more concerned about?
Well, both sides of the dual mandate are under pressure, as you noted right now. We have inflation that's too high and has been trending upwards over the past year. We got one report on the labor market, which is showing some signs of slowing, which is something we need to be attentive to. But the unemployment rate came in at 4.2, which is right around that maximum employment number, and has been really stable around that level between 4% and 4.3 for the past year. So when I look at the balance there, to me, it's important that we maintain a modestly restrictive stance of policy to continue bringing inflation back to target.
On inflation, you and your colleagues have been waiting to see what the impact of tariffs are on inflation. But when we look at the most recent inflation numbers, we saw a little bit of upward pressure on the goods side, but the services side started to pick up. Does that indicate to you that perhaps pressure is building for more widespread inflation in our economy? And given that we saw wholesale prices increase, is that a precursor for prices to be passed on to consumers in the coming months?
So it's something we're watching very closely. I think one of these big debates has been around what is the impact of tariffs going to be, in addition to the other policies that the new administration is bringing in, whether it's fiscal, immigration, or deregulation. And so we're trying to think about that holistically and what those impacts will be. I would say that what we saw in these most recent inflation reports, and again, we try not to make too much out of any one series of reports, we'll get a lot of data before the next meeting, is that you saw that wholesale prices were going up more significantly, but not necessarily being passed on to consumers. That tracks with what I'm hearing when I'm out traveling in the district. And I'm hearing from manufacturers that they're trying to buffer these price pressures as much as they can, but that's not going to last forever. And so some of these price pressures that are coming into the PPI and coming into the wholesale space will eventually make their way into the consumer space.
Building on what you're hearing from contacts in your district, in terms of the impact of tariffs on inflation, we now have some greater clarity on what tariff rates are going to be for certain countries, semiconductors. We have an eye into perhaps some of these exemptions. So how quickly do you think, you said it's not going to last forever, that the fact that companies are buffering consumers, how quickly could we see pass through, and how is that informing your outlook?
Yeah, so when I think about the tariffs and the impact that it can have, it's just now, I think, that we're starting to see some of those impacts play through into the economy. It usually takes 3 to 4 months to start seeing the early impacts of tariffs. And so we're just at that point right now, just past that 3 to 4 month mark. I do expect from the conversations I've had that we're not going to see the full impact of tariff pass-through until sometime next year. There are a lot of prices that only get reset once a year, some contract negotiations that happen around the turn of the year. So it could be that we're still continuing to see some of these impacts in Q1 and Q2. In terms of whether tariffs are going to be a one-time price level impact or more persistently inflationary, certainly the economic theory would say it would be a one-time price level impact, but theory and practice can be quite different. And the way most models think about tariffs is kind of a one and done, a one-time, very clean, we're putting an X% tariff on something and that's it, it's stable. Of course, the way that tariffs have been implemented here, there was a lot of negotiation, a lot of back and forth, and it played out over a much longer time period. And so it may not be that the economic theory really holds in practice.
And so do you suspect we could see more persistent inflation as a result?
I'm certainly attuned to that. My biggest concern is that inflation has been too high for the past 4 years, and right now it's been trending in the wrong direction. And so I think it's really important that we stay modestly restrictive to make sure that we can bring inflation back under control. When I'm out in the district talking to people, I hear constantly about this two-speed economy. I hear about affluent families who are doing really well, really enjoying how the stock market is doing. That's adding to their outlook and how their confidence in the markets. But on lower income families, inflation has been really biting hard. It means that more of their paycheck is being used for food, for housing, and they really don't have money left over to buy new school supplies, to buy new clothing that their kids need as they head back to school.
Turning to the outlook for the jobs market, we did get a weaker payroll number for July. If we were to get another weak reading for the month of August and or see downward revisions to the prior months, putting the 3-month average job growth rate in negative territory, how would you view that in terms of your goals, given where inflation is right now?
Well, I'd have to view that in the context of other indicators that we're looking at. So right now, with the changes that have happened in immigration policy, it's not clear that that headline growth number is going to be as informative as things like the unemployment rate, the vacancies to unemployed ratio, other things that we're looking at on the employment side of the mandate. And that's because we've seen a massive shift. And so, yes, labor demand may be coming down, but labor supply has come down pretty dramatically as well. And so our goal of maintaining employment around maximum needs to look at both sides of that. And it could be that even though we're seeing much slower headline job growth numbers, it could be that the labor market is still in balance. And so we'll need to look at that closely and unpack not just those headline numbers, but the unemployment rate, the vacancies to unemployed ratio, which has been reasonably stable and above 1 at its latest readings. And we also in Cleveland look at things like the WARN notices. So are there massive layoffs that are happening? Are notices happening there? Right now, it's ticked up slightly, but it's not out of historical norms. And so again, when I take the balance of things, there's a lot to be focused on the labor side, but the inflation side is right now giving us a place where we're not at our target. We're at our target on the employment side. We're worried that maybe possibly that could break down, but we know we're missing on the inflation side. And to me, we need to stay laser focused on that to make sure we can bring inflation down.
Before I turn to monetary policy, to your point on the job market, do you think that the unemployment rate is still an accurate indicator given the impact of inflation? Is it just that, given the impact of immigration, is it just that we're seeing a lower break-even rate? How should we unpack that and look at that?
Yeah, I tend to think of the unemployment rate as being one of the more steady indicators that we can look at because it does balance both the supply and the demand. And so if you're looking at the headline growth number, that's really more on the demand side. It doesn't tell you much about the supply. The vacancies to unemployed gives you a little bit of both sides. But I think that unemployment rate is one of our best indicators that we have.
Okay, and then turning to monetary policy, you said in a speech back at the end of June that it may well be the case that policy remains on hold for quite some time before the committee initiates very modest cuts to return policy to a neutral setting. Do you still believe that?
I do still believe that. I think that we have a very small distance to go to get to a neutral set of policy. And I would only want to move into an accommodative stance of policy if I thought that the economy was materially weakening, which I'm not seeing evidence of right now. I'm not seeing any signs of potential significant downturns. And to me, that's what would require us to move into an easy stance of policy rather than our currently modestly restrictive stance. So I don't think we have far to go. I think it can be quite some time.
So that means you see holding rates steady likely come September.
I think that there's a lot of data we're going to get between now and September, and I walk into every meeting with an open mind about what the right thing to do is. But with the data I have right now and with the information I have, if the meeting was tomorrow, I would not see a case for reducing interest rates.
And you said that you see very modest cuts to return to policy. How far are we from neutral at this point? How many cuts away, if you will?
I don't think we're very far. I don't disclose my dot, but I think we're right around. I mean, my longer term rate is towards the higher level. I think the economy's been incredibly resilient. You look at financial conditions and they are broadly supportive of the economy overall. I'm not hearing that interest rates is a huge problem, and that's the thing that's been holding things back. Even if you look at the housing sector, I know people like to talk about the impact rates have on housing, but when I'm out talking to builders or I'm talking to businesses about building new plants, what I hear is that the cost of materials and labor are as impactful and as important, as much of a barrier to beginning new construction projects as interest rates.
Switching gears a bit, President Trump is looking to sort of push Fed Governor Lisa Cook out of the Federal Reserve Board. She's holding her ground. When you look at some of these actions and pressure from the White House on the Fed, how do you view that in the view of Fed independence and setting policy?
So I think of them as completely separate. I think of the way we need to set policy is to serve the American people and to make sure that we're providing an economy that meets our dual mandate of maximum employment and stable prices and offers opportunity and growth for all Americans. I try to tune out the other parts of things that are going on around us, and I would say Fed independence is critically important. There's a large body of research that shows how economies that have independent central banks have better outcomes for their economies, both on the labor and the inflation side. And then finally, on Governor Cook, I would just say that I know her to be an outstanding economist and a person of high integrity, and I know she released a statement yesterday that I would just refer you to look at.
Beth, thank you so much for your insight. I so appreciate it. Hope
Thanks
to
for
speak with you
having
again
me.
soon.
Yeah, absolutely.
Great
Thank
to have
you.
you here in Jackson Hole. Julie, I'll send it back to you in New York.
Jen, great stuff. Looking forward to more of your coverage there from Jackson Hole. Thank you. Coming up, we'll dive into the tariff pressures rocking the beverage industry with the co-founder of Arizona Beverages. That's next on Market Catalysts. Beverage companies are considering price hikes as rising costs weigh on margins. PepsiCo and Monster Energy among those looking to raise prices in the coming months. That's according to Beverage Digest, an industry publication. Now, tariffs may be forcing one iconic brand that hasn't raised prices on its signature canned iced tea in 30 years to consider a higher price tag. Joining me now, Don Vultaggio, Arizona Beverages founder and chairman. Don, thanks for being with us.
Hi, thanks for including me.
So I think of a can of Arizona iced tea with that 99 cents printed right there on the can. Are you going to be raising prices?
Hopefully not. We're doing all we can to hold the line and tighten our belt, try to get through this tariff issue, and then hopefully that will subside and the uncertainty regarding tariffs. And if that does, we're going to hold the price for a bunch more years.
So, when you say you're trying not to, what kind of levers are you pulling on there, Don? And we should make clear that when we talk about the tariff impact for you guys, let's talk about that for a moment first. It's mostly on the material used to make the cans, right? The imported aluminum that you're using to make the cans?
Yeah, but most of our aluminum comes from recycled metal that's harvested in America. So, I think there's some manipulation going on with some of the producers to tariff affect things that aren't really being tariff affected because they're not coming across the border. And unfortunately, some things like that are out of our control, and we're trying to work through those as well.
Is one goal to try to produce, or to source a 100% of that aluminum from that U.S. scrap and recycled aluminum?
Well, a certain percentage of the aluminum has to come from virgin ingot,
Gotcha.
But that's a small amount. We use about 70 to 80% of it recycled in America. Aluminum is recycled, could be recycled thousands of times, which is the great part of aluminum, and the benefit to the recycling versus going in landfill, that kind of thing. But the point is, most of it comes from recycled metal, and then it's turned into block and sheet, those can manufacture.
So, Don, drill down into this a little bit for me. What kind of volume of cans are we talking about here? What effect is it having on your profit margins? And how long can you kind of get squeezed before, you say you hope not to. Like, what's the tipping point for you?
Well, the question is whether this situation is going to continue or it's going to come back to normal. Back in 2007, we saw a dramatic spike in aluminum as well, and then 2008, the economy meltdown. Aluminum then came back to earth. That's the last time we kind of looked at whether we have to raise price or not. Right now, we had a tariff effect on aluminum even before the tariffs were put in place. So that indicates to me that there's a manipulation by the part of some manufacturers to affect the price of aluminum, even though some of those things haven't passed through to them. So hopefully some of that stuff will come back to earth, and maybe some of the people who are certainly in the know will zero in on when that is happening. And it might be happening in other things like steel as well.
Well, let's talk about what could change here potentially. Have you been in touch with the administration to sort of make clear the effect that this is having on your business?
I have not, but hopefully at some point we can have a conversation, because some things unintentionally happen. Nobody in America likes to have things brought in if they can make it here. I've used the term, bananas don't grow very well in Manhattan, and coffee doesn't grow very well in Brooklyn. And some things have to come in from overseas. When things can be made here and made here efficiently, I don't think Americans would think that's a bad idea. But, if there's not a capacity, the capacity of making and smelting aluminum in America doesn't exist. And if, in fact, that doesn't exist, then what's going to happen is consumers are going to end up paying the tab because things that don't exist here and there's no capacity in reserve, then they're forced to come overseas. And I think the administration should take a look at that as well.
Don, of course, not all of your drinks come in cans. Some of them come in plastic bottles as well. So are you guys kind of trying to change your mix shift a little bit to try to deal with all this? And we should mention, on the plastic beverages, you guys are lowering prices, right?
Yeah, because that's tied to crude, and crude's down at the $62 level, which I saw the other day. And our cost of making a plastic bottle has come down, so we're going to reflect that reduction and pass it along to the consumer. Our job as a manufacturer and a marketer is to give consumers a reason to buy our product, to grow our business. That's how we offset costs, and that's how we've done it over the last 30 years. It's not because we're selling the same amount, we're selling multiples of that, and therefore our fixed costs stay the same, and we're giving the consumer the opportunity to buy more of our product by offering great value as well as great product.
Lastly, in terms of other products you guys sell, you also, I believe, have a hard iced tea product. There's been some polling coming out recently that people are drinking less alcohol here in the U.S. I'm just wondering if you've seen any impact on sales of those products.
Well, those are new products, and they're growing in sales because they're new to the market. Right now what's happening in America is, in order to grow your business, essentially you have to steal it from somebody else, because the overall category is not growing. And better products and better priced products, like what we've offered and are offering, are a way for us to grow our business in light of the fact that the overall market's down.
Don, thanks for joining us. Interesting to hear your perspective on all of this stuff. Thank you.
Well, thank you for having me. Appreciate it. Have a good day.
You too.
Take care. Bye.
Coming up, we're taking a look at some of the top trending tickers on Yahoo Finance. We'll bring you the news behind the moves next on Market Catalyst. Now time for some of today's top trending tickers. We are watching Canadian Solar, Xpeng, and Cracker Barrel. First up, Canadian Solar reporting second quarter earnings and forecast revenue that missed the average analyst estimate. That report taking down not just Canadian Solar, but solar energy stocks more broadly, as that company sees margin pressure in the second half of the year as supply chain prices trend higher. We also, of course, have seen political pressure, or we should say political volatility around many of those solar names because of regulations tied to the One Big Beautiful Bill and rhetoric from the administration. Next up, Chinese EV company Xpeng seeing shares surge today. This coming on the news that its CEO has increased holdings in the company to nearly 19%. The purchase comes as the EV maker says it is confident that it can meet its target of breaking even by the end of this year. Those shares up 13% right now. And finally, we got Cracker Barrel. Shares falling by the most since April and extending declines for a fifth straight day amid a wave of negative social media posts surrounding a recently unveiled change to the company's logo. The Southern-themed restaurant chain originally had simple gold branding with its name spelled out in brown lettering when it opened in 1969. But take a look. In 1977, it added the seated figure of a man wearing overalls, leaning against a wooden cask alongside the name. The new campaign evoking the look of its original logo, and apparently shareholders and voices online are not happy. As of today, That was the top trending ticker on StockTwits. It's trending on Yahoo Finance as well. Josh Schaefer, who apparently has never set foot in a Cracker Barrel.
Nope.
But he's here to talk
I got
about
opinions
it.
on the logo, though. I mean,
sure you do. Everybody's got opinions on everything now.
Well, every good logo has like some kind of mascot, I feel like, right? Normally when you go back to the
Not
retro.
every, but many.
So I'll give you an example. A team I used to cover, the University of Wisconsin, just launched retro uniforms today.
Yes.
What did they bring back in? They brought back in Bucky the Badger, because it's a cute little badger and you put that on the jersey and people like it. I think it's nice to have the barrel in there. It's nice to have the guy
the man
in there.
hanging out.
And I also think, though, like, being semi-serious here,
yes,
having a sign that people have recognized for a long time. Yes, I've never been in Cracker Barrel, but I recognize the sign as I drive by, right?
Sure.
And you know that logo, and I think part of the reason you know the logo is because of the barrel and because of the man kind of sitting next to the barrel, right? So if you remove that, I don't know, maybe it's a little less recognizable.
Okay, so let me sketch out the Cracker Barrel vibe for you, since you've not been to Cracker Barrel. It is a very cluttered kind of store. They have lots of tchotchkes around there, though they probably wouldn't use the word tchotchkes. Lots of things around, trinkets around, decorating the store. There is actually a store in the front that sells stuff, and then there's the restaurant as well. And it does have that old country feel. You get your cornbread, you get your biscuits, you get your grits, that kind of stuff at these restaurants. And in many cases, it's probably a good idea to modernize a logo, right? You want to bring something into a new age, signal to people that you're renovating, that you're refreshing, which apparently is what Cracker Barrel is also doing.
Okay.
But in the case of a Cracker Barrel, if people want comfort, if the whole idea is a comfort food and a country feeling, maybe they don't.
They removed the phrase old country store, too. I just feel like normally when you see the rebrand, it's to go toward nostalgia, not away from nostalgia.
Lately, perhaps.
Right? That's
Maybe
that's the move now, is like, let's do something from 40 years ago and like bring that back, and people will be like, oh, I remember that, that's cool. Like, old country store, we had one in my town growing up, right? And you would go and they sold everything under the sun and petting candy and that type of stuff.
Did that really exist in your?
Yes.
Really?
Mansfield, Massachusetts, the old country store. It's closed now because things that sort of went by the wayside, I think, a little bit in culture. But for me, it is a nostalgic thing to see a country store, and I think that brings back some memories for some people.
Yeah. You know, I like the sort of candy cane candies that are not peppermint flavor, but that you get at those kinds of stores.
Yeah, fresh mint.
That's what I remember.
Okay.
From as a kid. Well, in any case, it's still trending. We'll see what happens with Cracker Barrel if they back up.
Bring the logo
on
back.
This or not.
I bet they might.
And in the meantime, we need to get you to a Cracker Barrel, clearly. All right, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Existing home sales ticked unexpectedly higher in July, up 2%, but affordability for buyers is still the fly in the ointment, and that's weighing on the overall pace of sales. Here's what our Yahoo Finance guests have told us about the state of the housing sector as of late.
I get to travel across the country and visit our builders in every part of the nation, and definitely over the last couple of months, we've seen a slowdown. And it's all about the rates. To paraphrase Bill Clinton strategist James Carville, it's the rate stupid.
Property insurance, homeowners insurance has gone up well over 70% in the last 5 years. So, and then property taxes have gone up dramatically. So just the carrying costs along with everything else of owning a home is expensive, but they're able to stay in the homes by tapping into home equity. I think that home equity is only going to accelerate from here.
We're looking at mortgage rates that are significantly above where they were during the pandemic. So those costs really haven't adjusted. You know, if we look at for younger households, so those are those households that are likely to be most flexible between renting and owning, or on the fence between renting and choosing to buy a home, that's where we've seen home ownership rates slip the most.
I'm joined here on set by senior housing reporter Claire Boston. Claire, we've been having a lot of discussions about housing lately, but it is interesting to see this existing home sales number go up. How much of a surprise is that?
Yeah, so this was a surprise to the upside. That being said, we're still holding at what they call the seasonally adjusted annual rate of only about 4 million homes a year. And that is basically like lowest level in 30-year territory. So, a little bit of good news, but those fundamentals about just how expensive it is to own a home right now because of mortgage rates and because of where all-in prices are, we're still really seeing those buyers on the sidelines, those sellers with the 3% mortgages, they don't really want to sell. So, a little bit of good news here, but, no wholesale change in the market, at least at this time.
Well, and we've also been talking a lot recently, and you and I have talked about it, about mortgage rates, right? And that they have come down, but as one guest said to us, you know, the amount by which they've come down is not enough to unfreeze the market, right?
Yeah, definitely. So right now, as of last week, the average 30-year fixed mortgage rate was 6.58%. That is the lowest level in about 10 months. You know, that being said, you know, that is so much higher than those 3% rates that we saw. And the average home buyer is not really saying, wow, rates are down, I'm gonna jump in now that they are, you know, 6.58, 6.6%. It is still just really, really expensive, you know, on a monthly payment basis at these levels. And, you know, I talk to people who, you know, do mortgages, and they often tell me, you know, I think that we need a level, you know, below 6% before buyers would maybe really get excited again.
And you were talking about pricing and affordability. So the median price was still up 0.2%. The median price in the U.S. is now $422,400. So you have that price. You put, even if it's a 6.5%, even if it's a 6% mortgage on top of that, it's just not affordable for a lot of people.
Right. I mean, that's the thing. Like, your purchasing power as a buyer right now is just so much lower at these prices and at these rates. And, you know, what we are seeing a little bit is that the rate of growth in homes has been slowing. You know, we are up essentially on average almost 50% since before the pandemic. But, you know, we are seeing prices slow because affordability is just so challenged. You know, people can't get in the market right now, so they can't keep driving up these home prices. You know, that being said, it really depends where in the country you are. Places like the Northeast, where they're not really building homes, you know, prices there are still way up. But then they are falling in places like the Southeast, where they've been building a lot of homes. So it's like really this mixed bag of a market, and you know, it's leading to these numbers where home prices look flat. But you know, we really are seeing kind of two different markets right now.
Claire, thanks a lot.
Thanks,
Appreciate
Julie.
it. Coming up, Jared Blickery does some jargon busting for us with the latest stocks and translations. Stay here.
AI isn't just hot, the stadium gates, they've been flung wide open, but everyone is rushing to the same two merch booths, that would be NVIDIA and Microsoft. In today's Stocks in Translation, we're going to show how to play the AI game with ETFs and also how to avoid too much concentration in the usual names. First, a quick refresher on what an exchange-traded fund actually is. An ETF is a fund that holds a basket of stocks and sometimes other things like bonds or commodities, but trades like a single stock all day long. It's a simple idea and a fast way to own an index like the S&P 500 or a theme like AI. Now take a look at all these AI ETFs, 23 in all, with 4 added this year alone. The performance is year to date, and keep in mind some of these names haven't been around that long. Now, according to Todd Sohn, CMT at Strategas ETF Research, who I'm going to lean on heavily for this presentation, they have nearly $17 billion in assets, and most of them, 16, have come after ChatGPT has become mainstream. Now, take a look at this chart that shows the total AI ETF count as it has evolved since the very first one in 2016, which was the Global X Robotics and AI ETF. Since 2023, this line gets very steep, showing huge institutional buying interest. Now, this gets into the product for markets like investors, and if anything, it shows that we're still in the early innings when it comes to building out AI funds. Now, this chart here is what's called a scatter plot. Each dot is one of the 23 ETFs, and the higher it's positioned vertically, the more money it has, or assets under management. And from left to right, it's just the timing of when they were introduced, and that's the same data as we were looking at in the previous chart. Now you can see that the line shows where the ChatGPT era began, and it captures about 70% of the number of ETFs. What you're also going to notice is that older funds towards the left, they tend to be the biggest. They have the most assets. But there are a few exceptions, as we have some newcomers toward the right of the chart that are getting pretty big pretty quickly, like 2 iShares ETFs, along with the Dan Ives Wedbush AI Revolutionary ETF, ticker is IVES, and it's not every day that an analyst gets their own ETF. Now, take a look at the money flowing into these funds. This chart by Strategas goes all the way back to 2021, and it uses a 65-day rolling window to look at flows into this group of funds. All you really need to focus on is how the line representing flows is accelerating recently at the right side of the chart. But AI isn't just chips and software. This chart here tracks flows into utilities and infrastructure ETFs, the power, the pipes, and the data backbone. Flows aren't soaring quite as much as a prior chart, but they're definitely heating up and approaching the top end of their historical range. This is what we call the picks and shovels angle for AI. Now, we need to address the issue of concentration. The picks and shovels trade we were just looking at can be a good way to diversify, because if we now look at the original group of 23 AI funds, we see a lot of familiar names popping up in their holdings. That would be NVIDIA, Microsoft, Alphabet, Meta, Oracle, Amazon, even Palantir. On average, it's the 23 AI ETFs we've been looking at. Inside them, the NVIDIA weighting runs about 6% and Microsoft about 4%, so 10% total, and that's just an average. But some of these ETFs have no exposure to the big names, and weightings can vary drastically. So the bottom line is, when buying any ETF, always do your homework, please. And remember, if you already own passive funds that track the S&P 500 and NASDAQ 100, you already have a lot of exposure to the big AI companies. So search for the holdings in the ETFs that you're thinking of buying, and don't forget the picks and shovels angle. Tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you...
Let's check in on the markets now, because we are seeing stocks come up off the lows of this early session. Some economic data to parse this morning, including jobless claims, which came in a little higher than estimated. But then we got manufacturing data from S&P that was much better than had been anticipated and was the best reading we've seen in a couple of years. So all of this feeding into what we may hear from Jay Powell tomorrow. If you take a look at the Wi-Fi Interactive, I'm just looking at the Dow here coming up off the lows of the session, still under pressure though because of Walmart. S&P 500 kind of going sideways here, and the NASDAQ down about 1/5%. I was also looking at the 4-day chart here, because in terms of what we're setting up for on the week overall, the NASDAQ looking like the big loser, as we have had this sell-off in tech persisting. Right now it's set for a decline of 2.25% on the week. And then sectors today, just digging in there a little bit, we've got consumer staples down the most. That's because Walmart is in that particular group. That's the XLP you see on the lower right there. But XLY, consumer discretionary, is also under some pressure today. On the flip side, we got XLV up 0.6%. Remember, we got some more details of the US-EU trade deal that seemed to include just a 15% maximum tariff on pharmaceuticals. Remember, President Trump has floated numbers as high as 200% on some of those. So even though it was going to be over a long phase-in period, it does seem like perhaps some relief being expressed there. Moving on, Gen Z's financial reputation may be misleading. Younger investors are often seen as reckless, chasing meme stocks or crypto, short-term gains driven by social media. But a new study from Vanguard is busting some big myths. Here to break it down is Andy Reid, Vanguard's head of behavioral economics research, who put out this research. Thanks for being here.
Thanks for having me.
And it is interesting because we do think of young investors and young people, I guess, in a certain way. So let's go myth by myth here and talk about what we actually see. Myth number one, young investors are overconfident. What do we actually see?
Yeah, it's a good question. I think there's the perception and there's the reality. The reality is almost 2/3 of young investors are not overconfident. They don't think they could beat the market, and nearly half don't even consider themselves investors. So, there's certainly a small group of folks who are overconfident. They might think they're the next Warren Buffett. But the reality is most are calibrated in terms of their confidence. Some of them actually might need a confidence boost. So we see that underconfidence may be a bigger issue in some cases than overconfidence for young investors.
Especially because when you're younger, you want to take on more risk because you have more time. Which brings me to myth number two, young investors love risky portfolios. Kind of linked to myth number one.
Yeah, absolutely.
So what do we actually see?
If you buy the hype, you would imagine that all young investors, all Gen Z, are YOLOing on meme stocks.
Right.
The reality is, according to a FINRA study, 3 in 4 are not willing to take substantially higher risks for the chance of higher returns. So most have sort of reasonable risk-return preferences and tolerance. We do find that, on the one hand, there's a little bit of grain of truth to this myth insofar as individual stock ownership is at an all-time high for young investors, but it's only 25%. Now, by contrast, twice as many young investors are holding retirement accounts, which are typically invested in low-cost, diversified target date funds. So kind of the opposite of sort of the meme stock situation in terms of risky assets. What we find is that this myth about preferring risky assets and chasing risk is really overshadowing the reality, which is that they're hoarding cash. And they're hoarding cash both in the places where you wouldn't expect it, like IRAs, as well as in places where it's not earning much interest. So on the IRA side, your typical young investor who does a rollover and changing jobs, you roll over from 401k to an IRA, it's surprisingly common. They stay in cash for 7 years or longer. So that's a lot of missed opportunity.
So in other words, it's not like they've gone into cash or cash-like instruments with rates going higher.
Correct.
Right? Which
Correct.
would be, I mean, not that you want to put all your money there, but that would be one strategy to take. That's really interesting. And of the 25% that you mentioned who are in individual stocks, do we know what that mix looks like, right? Is it the NVIDIAs and the large cap techs of the world? Is it the AMCs and Open Doors of the world? Do we have any visibility into that?
Well, so the 25% stat actually comes from a nationally representative survey, and so they don't break it down into the actual holdings. We could characterize Vanguard young investors, but they may not represent the entire national base. But typically, you do see sort of the large cap stocks, attracting a lot of attention from young investors. Tech is something that they gravitate towards, but it's not the fact that their entire portfolio is allocated in this way.
Right, makes sense. And then finally, myth number 3: young investors are soft saving for retirement. So first of all, what does soft saving mean?
Soft saving is like cutting yourself a little bit of slack and saying, well, I'm not going to worry about retirement. I'm going to deal with that later. I'm going to live my life the way I want to in the here and now, and I'm going to treat myself. And the reality when you look at the national data, first off, Gen Z is doing better at saving for retirement than millennials were at the same stage of life 20 years ago. So they're more likely to participate in 401k plans, they're saving a higher percentage of their income, and they have larger account balances. So this means that every 2 weeks, like clockwork, they're saving and investing a significant amount of money for retirement in typically, again, age-appropriate target date funds, so low-cost diversified investments. When you look at the spending side of the equation, there's not really much evidence that they're spending, a significant amount of their money on self-care products, which is sort of the myth. The reality is they're spending it on basic necessities more than anything else.
And you have to think that their philosophy is shaped by coming of age during the financial crisis, right? And so they, you would think that yes, you have these myths that are out there, but you would think that they would be shaped by that and would express some caution as a result of that.
Yeah, absolutely. I mean, I think, when we hear about sort of the retirement crisis, I think young people are not oblivious to the fact that the future of retirement is uncertain, that a lot of people are not on track. And it's sort of a natural human tendency that if a goal feels unattainable, you kind of back away from the goal. And the reality, though, is that young investors, young workers are saving for retirement better than ever before. So that's the good news. But there's a big twist, though. There's a big caveat.
Tell me.
It's all about automatic enrollment. So when they're in a 401k plan that's automatically enrolling participants, 90% of them participate. When it's voluntary, 25%. So I think that's where the myth comes from. It's, they don't even realize that they're doing so well saving for retirement. So they're not giving themselves that much credit, which they actually deserve.
Okay, but also at the places where you have to opt in, they should be opting in.
Absolutely, yeah. We're doing our best to nudge them to take action and take care of their future self.
Makes sense. Andy, thank you so much. Appreciate it. Really interesting stuff. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.